Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Resilience in the face of a once-in-a-century tariff shock has been a defining theme in the markets this year. While company earnings worldwide have held steady, the key question for investors is what is this fall and into 2026 going to look like? How will tariffs affect companies going forward? How will they impact different countries and companies and asset classes differently? Today, we're going to be taking a closer look at how the tailwind of artificial intelligence is being balanced against some of these headwinds and where opportunities may lie for you and your clients in the months and years ahead. Joining us for a conversation on the state of the market is Andrew Marchese, Fidelity Portfolio Manager and Chief Investment Officer. Andrew leads a high-performing team of over 100 investment professionals, including portfolio managers, research analysts, traders, and more, and manages over $100 billion in assets. This entire discussion with you, Andrew, a warm welcome to you, will be also in live French interpretation. So we welcome everyone here and welcome you. How are you?
Thank you. Very well. Yourself?
I'm very well.
Good.
Yeah, delighted to be here in September. And it's a little more than back to school, what we're going to talk about today. Do send your questions in for Andrew for the next little while. Let's talk a little bit about the state of the markets, what we have seen, and really ask you why the resilience is here, because it does seem, even after a wobble of a few days, we're still climbing.
Yeah, through my lens, I think you always point to a couple things in the pillars of investing. So one, we'll talk about earnings, and two, we'll talk about interest rates and liquidity, and lastly, valuation. So on the earnings front, we came into the year where on the S&P 500, earnings forecast was for about 12% growth. As we know, we kind of walked through the tariff announcements, Liberation Day on April 2nd. Shortly thereafter, forecasts on Wall Street went from about 12% to about 6.8% at the lowest. Tariffs kind of got the can got kicked down the road a little bit, some delays, some got ratcheted down. All in all now, earnings forecast is for about 9% earnings growth on the S&P 500, which actually isn't so bad and actually in line with history. We were talking off camera about typically every year you start the year kind of almost too optimistic. Those numbers get ratcheted down a little bit, but going from 12 to 9% growth, if indeed the 9 turns out to be true, isn't actually so bad and is in line with history. But I think what has kind of catalyzed the leadership off the bottom, April 8th, the U.S. has actually kind of taken over. Everybody was talking about rest of world. It's actually been the U.S. and more specifically the Mag 7 or large cap growth. And I think that really dovetails with fiscal policy, so big beautiful bill, and then the market quickly turned to Fed independence and just talking down interest rates. So, you know, the administration has been talking down interest rates since April, and it's gotten louder every week that's transpired since about Liberation Day.
It really has.
The market's looking forward and pricing in the fact that, okay, maybe the tariffs do slow down the economy to a degree, and that is actually happening. It's showing up in economic numbers. For those out there who have heard me speak before, I've talked at length about cycles aren't what they used to be. There's not these boom bust cycles that we've seen historically going back many decades.
Is that good for investors?
I don't know if it's good or bad. I think it is what it is.
Okay.
So you never get too far away from, if we use 50 as the barometer for PMIs and service PMIs growth, you get a little above 50, a little bit below 50, but you never boom bust. And some people would say that's actually a good thing. Now, what it does do, which makes investing a little bit more tricky, is you have to be a little bit more attuned to where the leadership may come from. And I think because you don't have those conventional cycles, which were a little bit more predictable around what a recessionary cycle looks like and what sectors or factors lead at various points during that investment cycle, because you don't have those clearly defined cycles anymore, it makes leadership a little bit more blurred. And so we have to point to other things. And also the financial industry in general is changing. There is far more financial engineering with ETFs, factor-based ETFs, smart beta. There are more decisions being made in investment in equities for non-fundamental reasons. And so we have to be attuned to all that.
So there's so many things I want to pick up on there. The interest rates, the liquidity piece, the Fed, leadership. But actually, let's go to that discussion about really AI is where you're going with that. I mean, this is a societal change that we're thinking about. And as it represents within the markets themselves, it's a financial engineering story, really, isn't it? I mean, AI is sort of part of that, but financial engineering has gotten to the point where big funds are moving money around in a way where you're not single stock investing really very much anymore.
It's a falling share of the total investment pool. That's how I would kind of phrase it. So if you go back to the 70s, 80s, even the 90s, there were decisions being made to invest in securities, buy and sell securities that largely came from a fundamental perspective. So you kind of looked out and bottom up, forecasted out future cash flow and profits, made some kind of assessment about what the interest rate backdrop should be, the discount rate you should use, and then invest accordingly. And those how the large majority of decisions were made. And as we got into the 2000s, the advent of quantitative investing, and that's further matured and evolved over the last 2 decades. The financial engineering, you talked about ETFs, you can get exposure to factors, whether it's momentum or yield or low volatility. You can invest thematically. If you think AI is going to be a big thing, you can't quite quantify it, but you want a basket of AI-levered securities that, whether it's things like the picks and shovels of it or businesses that will benefit in the future from a cost perspective, productivity perspective, we can bundle that for you. So that, by definition, with all that financial engineering, people are making decisions on investing in securities, which drives the marginal price of the underlying stock, the price itself of the single stock, for non-fundamental reasons. So
up or down. I mean,
up
it
or
drives
down.
it. Yeah.
So before, in the 70s, it was all fundamental. Now it's not. And so you have to understand that, I think, in the context of investing. It also allows you to have more opportunities to invest and build your portfolio from a total portfolio perspective, a fund-of-fund perspective, create offset risks through low or negative correlations in your portfolio. So I think it's all a good thing, but when you're looking at single securities, you have to understand that the marginal setter of price isn't what it used to be 50 years ago. And so
that's so interesting. So, I mean, along with the many, many things that you do and managing billions and billions and billions of dollars, you're also the head of the research side of things. So how does it change research?
I think there is a axiom in investing that stocks do follow earnings. That won't change. If the profits aren't there, then eventually the price has to reflect that. So that won't go away. What I think it will do is that in the short term, it causes aberrations in price. Because if there are factors that are pulling on the demand for a security, right? It's all a case of supply and demand sometimes too. If more people want to buy a security, it goes up in price. If less people want to buy a security, it goes down in price. In the short term, if there are more forces at play that are acting in a different playbook from convention, as I said, like 50 years ago, then in the short term, it may cause aberrations in price. So from a research or fundamental perspective, you have to understand that and say, well, maybe we should take some risk off because price is being abnormally reflected. The price is too high for this. And eventually that will mean revert.
Is there a question in here when we're talking about resilience of markets? We're seeing markets, hang in there, doing okay through all kinds of geopolitical and monetary and other situations. Is it actually they're hanging in there because of some of the aspects that you're talking about? Is there strength in what you're talking about, and maybe not being able to see the signal as well? I mean, there might be a little bit of both there.
Well, I think one, there's a lot of money in the system. So again, for those on the video who have heard me speak before, since about 1987, we've gone into injecting incremental amounts of liquidity into the system without really taking the same amount out.
Isn't that what interest rates were supposed to do over the last year and a half, 2 years?
Right, and it worked for like 2022, right? Because inflation got a little out of hand, raised interest rates, but where are we today? We got inflation, back down to, I think, not goal levels, but a lot better than it was in 2022. But you think about it, in the 90s, we had currency crisis that was treated with more liquidity. Raised interest rates, kind of snuffed out the NASDAQ bubble of 2000, but then interest rates got cut, built a credit bubble, had the global financial crisis. What was the remedy? More liquidity, QE. That happened for the next decade. You got to COVID. What happened? Liquefy the system, actually of quantums higher than what you had in the GFC. So you've never taken the money away. So there's a lot of money sloshing around in the system. And now you have this year in the US, you have fiscal stimulus. You probably have monetary stimulus to come if you believe the administration. And they've been very transparent about wanting about 150 basis points of rate cuts from this standpoint. So there's a lot of money on the system. Back in the COVID years, I talked about there is no alternative. When you got interest rates that low, it pushes you out on the risk curve. So you're more willing to take on risk. That boosts the prices of risk assets because you can't and you shouldn't stay in cash. And so the ramifications of that are an evolving story. It's a book with many chapters, and we're going to go down these roads with a lot of this money kicking around the system. Prices will fall and rise and so on and so forth, and we'll have to deal with it accordingly.
At the moment, you mentioned leadership earlier and how we're very much back to where we started the year. It's the Mag 7. And a lot of that money is aimed at them in terms of investment money and also in terms of the companies themselves deploying it into the economy with what they're spending on the AI build out. That must be good, ultimately, not just for investors, but when you think about the speed at which, when there's that much money to put at something, it goes to those winners. What about the rest of the stock market?
Right. Well, it's interesting when you put it like that because I'm getting flashbacks from 2000 because the same thing kind of happened. It was like that, right? So with the internet, and so there were winners on the build out space. We remember companies like JDS Uniphase and Nortel and WorldCom and EMC and Dell and
Ancient
Cisco.
History now.
Right. It was all a hardware picks and shovels discussion. But the real beneficiaries of the internet were the software companies and businesses that grew. Google was not a company in 2000, or if it was probably like a shingle. Like it wasn't. It was an idea. They're one of the top 5 beneficiaries of the internet build out. But in 2000, we talked about everybody who was building the internet. The internet destroyed the department store.
Right.
Single-handedly destroyed the department store. So the question for us as investors is, if AI turns out to be as good, if not better, than what we are dreaming of today, what industries change and benefit from a profitability standpoint? What industries go away? And I think that if you talk to 100 people, you'll get 100 different opinions.
Right.
On
Nobody
that.
really knows.
Nobody really knows. And that's why it's so exciting. I think it's really exciting because we're at the forefront of major change that's going on. I think the biggest risk to equities is AI actually turns out to be a dud, which I don't think is going to, but I think that would be the thing that would alarm everybody because there are a lot of decisions, hopes being made on what the future will look like. From a productivity perspective, a growth perspective. You talked about the capital coming into the system, which is generally good for the economy. That to me is the biggest risk to equities.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
That's really interesting. I mean, so when we saw NVIDIA come out with their earnings, there was sort of that bated breath moment, and we did see a reaction and so on. When you say a dud, do you just mean it's commoditized?
No, I don't mean that necessarily. I just mean the productivity gains don't reach our expectations.
Okay, so it's not that just DeepSeek could do it cheaper.
No.
That's not.
That's a very specific investment consequence of investing in very specific AI-related companies. What I'm thinking of more is it changes the way we live we work, it makes certain companies' growth go in a hockey stick fashion. I'm not talking about the people who are building it. I'm talking about industries that never had it, will use it, and all of a sudden, the spectrum of outcomes becomes great for these businesses.
Right.
A lot of, particularly a lot of white collar businesses, healthcare. Like, what does it really mean? And the quantums that our future GDP kind of realizes because of it. Also,
as in quantum computing, like
well, and that's another aspect
that's
of it too, and that's another specific aspect of this whole AI build out.
So how do you, as an investor and as leading this group, how do you stay very close to it? Because the only way to sort of take part in something that you don't know where it's going is to stay very close to it. How do you and your teams stay very close to it?
The easy part, much like 2000, has been in investing in the picks and shovels, right? So those companies who are building it out and demand for their product,
right.
Obviously because of the CapEx boom, they benefit in real time. The harder part is going to be, okay, in speaking to these companies, how do we plan to employ it? What level of productivity are we getting? Is it just nice to have? Is it revolutionary? Is it evolutionary? And I think it's really talking with the companies to kind of having, to get a better sense and comprehend how that will change their business from a cash flow, from a profits perspective going forward. What other businesses are going to be potentially wiped out?
It's almost like taking on a great big merger acquisition and sort of when will it be accretive?
Right.
On some level.
Yeah, in some ways, yeah. It's a good analogy.
You have to sort of go with the investment up front. But presumably, so in terms of industries that will be wiped out, can you tell? I mean, this is sort of a printing press moment. It does get discussed like that.
Yeah, exactly. Buggy whip.
Yeah, exactly.
Right. So I think it's too early to tell. We all have our guesses, and it may not even be industries that get wiped out. It's certain jobs that get wiped out within the context of that industry. So too early to tell, because I don't think anybody really has a good handle on what we're dealing with here.
So we live in a country that notoriously has a productivity problem, and people study it from a million different angles, and they don't seem to really know why, but we do.
Yeah.
Are you, well, to be blunt, are you bullish on Canada being able to implement this properly for sort of a national story of companies within that can work this through? I
think and this is my own personal opinion, the productivity problems related to Canada has been in part and parcel more things related to policy,
yes,
taxation, and brain drain. And there's probably a few other things I'm forgetting, but those are the things that have to be addressed first. I think the implementation of technology will naturally happen in Canada, globally, because that's what we do as humans. We use tools, and businesses will do that. But I think the greater productivity issues relate to those three things that I mentioned, and I think we need to address those, and we should have been addressing them for the last 20, 30 years.
Yeah, and sort of now is the time.
Yeah.
There are a number of questions, Andrew, coming in here, so let's put some of these. So you certainly, I think you mentioned gold a little bit there, but here's the specific question. So the strength of gold and silver, has it surprised you?
No, it hasn't surprised me. I've been on the record in the past, and people ask me, "What are you bullish about?" And it's gold. It's hard to get more concrete than that. Meaning, I can't give you a price that I think bullion trades to.
Yeah.
But with all the financial, the liquefaction of the system, hard assets by default need to benefit, and gold's one of them. Silver is a little bit more tied to industry, but people will arb play it against the price of gold. In other words, they'll use ratios,
yeah.
But it is a little bit more driven from an industrial commodity complex standpoint. But it's really about there is M2 money supply rising and rising and rising. So it's hard to create a bearish, in my opinion, it's hard to create a bearish argument about the price of bullion with all these forces still at play. If they were to change radically, then that opinion would change.
Okay. Okay, very interesting. A couple of questions here. So given the current tariff situation and downward pressure on rates, do you see elevated concerns around holding U.S. sovereign debt products, treasuries?
Treasuries.
So on?
That's a good question. I think some of the concern would be at the longer end of the curve.
Well, that's where the rates are going crazy.
Right,
Yeah.
exactly. So, and if you think this will catalyze inflation, then yeah, you would be concerned about that. If you are of the opinion that you will get 150 basis points of rate cuts and maybe more, as Scott Bessent was on television talking about not too long ago, yeah, you'll suppress the short end of the curve. And then the speculation is, would the administration, the Federal Reserve, others have to yield curve control?
Well, yes.
So you have quantitative easing to manage the long end of the curve. And that hypothesis has been adopted by many. Like I can tell you, many people out in the financial community think that is a necessary and probable step that
Wait,
that
just
they will
talk
take.
us through that. So you've got a very steep yield curve.
Yeah.
You want to control that a little bit. And QE is the answer.
Well, yeah, you might start buying
Just start
long
buying.
end of the curve.
So you just expand the Fed's balance sheet, basically.
That's
you go back to that.
Yeah, there are a litany of people out there in the investing community who believe that that step will follow if you get a lot of interest rate cuts. It would have to. That creates its own kind of
Japanification.
well, yeah, it creates its
Or
own
could, yeah.
series of topics, issues, problems, discussions. I'm not suggesting it will happen, but it is a possibility.
Great question here. With U.S., Mexico, Canada agreements, what possible outcomes are you considering for Canadian equities? Certainly as we sort of have this review coming up of the USMCA, CUSMA, whatever we want to call it.
Yeah.
Where's the Canadian equity picture fit? Maybe it's more an industry story, but.
Yeah, we're not directly making kind of investment decisions in Canadian securities based on what we think,
Trade agreements.
Trade agreements and what
Okay.
will resolve on that front. But I think Canada will continue to muddle its way through, and I think as long as the economy kind of muddles its way through, you look at the banking industry in Canada, will it be fine? So we have to see where PCLs go and credit goes. But
Well, they've been okay in recent earnings.
Exactly. And if you can kind of withstand this, can you withstand the future? And loan growth should be okay then if you can kind of get lower interest rates and change policy and maybe some forms of taxation to encourage small business and other industry, and we get build out of businesses and industries that are more levered to the rest of the world than just not relying on the US. That's a pro-growth aspect. And that would be good for the banks. That would be good for certain industrial companies and sub-industries. So on that front, there's a lot of potential on that front. To a lesser degree on oil, which is obviously the other big aspect of what we do in Canada, particularly from the TSX perspective, there's still a lot of oil kicking around. Yeah, there is still a lot of supply. And you can always turn on the taps a little bit to raise supply if you wanted to. So,
but it's there.
It's always there. It's hard to get wildly bullish about the price of crude. But and that was one thing that I didn't address when we talked about the economy. We talked about lower rates stimulating the economy.
Yeah.
Crude's down about 10% year to date. And if you get lower crude prices, that's a further kind of kick to the economy, right? So you could walk into 26 and 27, not suggesting for a second this will happen, but you got fiscal stimulus. You may have a fair degree of monetary stimulus coming, and if you could further drive down oil prices, there's a real kicker there.
So, I mean, this is part of the offsets discussion to the tariff narrative and so on. And there are significant offsets, as is the One Big Beautiful Bill and deregulation and tax and so on.
Yeah.
So what's the future look like, Andrew Marchese, for the next, I don't know, year? Are there enough balances of risks that have some cover for each of them to keep going?
I think what's happened since Liberation Day and the bottom of the market on April 8th is that the market has really looked forward to some of these things, fiscal and monetary stimulus, as being what will carry us through, and tariffs are a one-time hit.
Are they? That's what we keep getting told, but yeah.
I think it remains to be seen. I think we've done a lot of work, and a lot of historians have done a lot of work to suggest that tariffs are actually disinflationary, not inflationary. They're initially inflationary, but they're actually disinflationary over time. So
because you stop buying stuff.
Right. It hurts incremental demand for goods and services. But if your discount rate is lower and your balance sheet is good and you can take on debt at a low cost to carry, then maybe you're more apt to consume. Business, at both a business level and a consumer level. And then past 1 year, the holy grail is that you get into some form of technological revolution where AI or AI-like tools increase productivity, keeps inflation kind of under wraps because productivity is rising, and and this is more like utopia, you can thread the proverbial needle. Right, so what we talked about in the global financial crisis was there were two ways out of the predicament of the global financial crisis. Generally speaking, you can grow your way out of it, or you can inflate your way out of it. And the proverbial we in the investment community always says, well, there's really no growth engine that's going to
inflate your way out.
So you got to inflate your way out of it. And what if? It's just a thought. AI is actually that revolutionary growth engine that kind of changes the way we do things, and over time, and I'm not talking in it going from here to here in a year, I'm talking over like a couple of decades, you've changed the way we work, live, and so on and so forth, and you can suppress inflation. Productivity gains are huge. It catalyzes other changes in policy and how we think about employment, how we think about wages, all of this, like how we think about healthcare and the cost of healthcare and all this kind of stuff. And that's what threads the needle. As I said, that's kind of utopia.
But it is probably the goal of the U.S. administration. Is that fair?
I don't
Mostly?
know. I don't know if they're that long dated in terms of their thoughts.
Just a question as we head out. What would you say is sort of the biggest economic event or investment event that we know about currently that you would look towards? I felt like the Fed decision in September, which is still coming, was a little bit muted by the Jackson Hole comments because we got a bit of clarity on what Jay Powell was thinking. What else is out there that we need to kind of look towards, if anything?
I don't know if there's any one theme like in the short term that I think for us and what we do, we're just kind of going along security by security, industry by industry, trying to pick off things that we think where earnings and cash flow are going to be greater than consensus thinks over the next 2 years. Okay. And why is that? Maybe the industry has really kind of lagged for the last 3 years and things are looking better. Maybe because it's been part of an anti-momentum basket, the price is really depressed, and it's far more depressed than it actually should be. And I think we're looking at things like that on a case-by-case basis. If you were to say what's like a 1 year horizon, I don't think there's any one theme that I'm like totally...
Smaller cap companies?
Well,
does sort of everything else trade to an extent?
I think generally speaking, as a general statement, high level 30,000 foot statement, particularly in the US, they're a direct drive on the health of the US economy. So what has transpired over the last 10 to 15 years, though, is that the winners keep taking share, right? So the big get bigger, they get better, and that comes at the expense of smaller companies. So I think depending on the industry that you're referring to, yes, some small cap companies, if the US economy accelerates into 26 and 27, will benefit. Others are having their lunch eaten because the big are just going to take it anyway, irrespective of what the economy does.
And what rates do in that sense.
Right.
Andrew Marchese, a delight to see you and to set us on course through September. Thank you for joining us today.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.